Ladies and gentlemen, good day and welcome to the Raymond Limited Q3 FY22 earnings conference call hosted by Antique Stock Broking Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone telephone. Please note that this conference is being recorded. I now hand the conference over to Mr. Abhijit Kundu from Antique Stock Broking Limited. Thank you, and over to you, sir.
Yeah, thanks, Kathy. On behalf of Antique Stock Broking, I would like to welcome all the participants in the Q3 FY22 conference call of Raymond Limited. I have with me Mr. J. Mukund, who is the Head of Investor Relations of Raymond Limited. Without taking further time, I would like to hand over the phone. Over to you, Mukund.
Thank you, Abhijit. Good evening, everyone, and thank you for joining us for Q3 FY22 earnings conference call of Raymond Limited. I hope all of you would have received a copy of our results presentation. I would like to urge you to go through this along with the disclaimer slides. Today we have with us Mr. Amit Agarwal, Group CFO, Mr. Ganesh Kumar, Chief Operating Officer of Lifestyle Business, and Mr. Harmohan Sahni, CEO, Real Estate Business. I will now hand over the call to our Group CFO, Amit Agarwal, who will give you the summary of the company's quarterly performance before we open up the floor for Q&A session. Over to you, Amit.
Thanks, Mukund. Good evening, ladies and gentlemen. Thank you for joining us today on this earnings call to discuss our results of third quarter for fiscal 22. Let us quickly reflect upon how the market conditions were there during the third quarter. Domestic market witnessed an upbeat sentiment that drove consumer demand in the third quarter of the fiscal, backed by higher optimism, festivities, and wedding-related purchases. The sustained rebound momentum witnessed from mid-August, post-opening of the markets, and improved vaccination in the country got further augmented with 100% store network operational, resumptions of offices, surge in travel, and overall festive moods starting from Navaratri in October, followed by Diwali in November and Christmas in December, resulted in accelerated our B2C sales. We witnessed the robust traction in secondary sales with higher footfalls in our stores as more consumers were able to indulge in shopping experience. The vaccination drive among the 18 to 45 year age group, which is the key customer category visiting malls, started progressively from May-June month onwards, for whom the second dose eligibility was applicable largely in August and September month, which were one of the main catalysts. This provided the much required impetus to both high street and retail outlets in shopping malls, thus increasing the confidence among our trade partners that resulted in strong revival across our trade channels. In the export market, strong momentum for orders was maintained in both garmenting and engineering sectors. From garment perspective, in US, UK and Europe markets, where consumerism is a key factor in driving the economic growth, there was strong retail sales due to buoyant consumer sentiment despite higher inflation and uncertainty about COVID pandemic. Before summarizing the financial highlights, we are happy to share that our third quarter fiscal 22 has been a commendable quarter in terms of overall performance of the company. The company has achieved significant number of milestones leading to a robust performance driven by strong focus on execution. It is a testimony to the fact that with a 95-year-old strong brand Raymond and pan-India presence across businesses, we are a resilient organization that has been demonstrating strong grit to bounce back stronger quarter on quarter. Let me now give you key consolidated financial highlights for the third quarter fiscal 22. In terms of our consolidated revenue, which grew by 45% to 1,871 crores from 1,286 crores in third quarter fiscal 21, reaching pre-COVID levels. This growth was driven by strong increase in sales across all businesses in both domestic and export markets. Also on a preceding quarter basis, the revenues were higher by 18% from 1,583 crores in the second quarter of fiscal 22. Similar trend was witnessed in second half of the previous year when unlocking and opening up of markets led to a strong growth in sales. This reiterates the fact that with recovery in consumer sentiments, there exists a strong demand for our products and services across the country as well as in the global markets. While revenues grew by 45%, our EBITDA grew by 93% over previous year, achieving highest ever EBITDA of 303 crores with an EBITDA margin of 16.2%. This was driven by strong performance across most of our businesses as compared to previous year. We also reported highest PBT of 186 crores and highest margin thereof of 9.9% in the last 10 years, driven by strong performance and reducing the interest cost. Through a combination of strong EBITDA and efficient working capital management, we generated free cash flows of 320 crores, driving the net debt reduction of 310 crores, leading to a net debt as on 31st December 2021 to the tune of 1,253 crores. Our net profit was over 4.5 times over the previous year, amounting to 100 crores in third quarter fiscal 22 compared to 22 crores in third quarter fiscal 21. Now let me discuss the operational performance in more detail. In third quarter fiscal 22, strong growth was witnessed across all businesses, resulting in 45% growth from 1,286 crores in second quarter fiscal 21 to 1,871 crores in third quarter fiscal 22. In our B2C businesses of branded textile and branded apparel, all the trade and retail channels have shown a stronger recovery, resulting in both these businesses growing by about 50% as compared to last year. In terms of our B2B businesses of high value cotton shirting, we witnessed strong pickup in domestic demand, resulting in high growth of 72% compared to previous year. Even the garmenting segment grew by 48%, driven by continued high momentum in our key export markets of US, UK and Europe. In the engineering business, where we have already recovered and achieved pre-COVID top line in third quarter last year itself, this quarter additionally we have been able to grow by 28% over the previous year level, driven by growth in export markets and continued improvement in domestic demand across categories. In the real estate business, we witnessed also a strong growth in number of bookings on the back of encouraging demand and fast-paced construction activity, leading to a sales of 175 crore, which is 177% growth compared to last year. Let me talk about the EBITDA and the operating cost. We have achieved the highest ever EBITDA of 303 crores for the quarter, which reflects a growth of 93% over a previous year and EBITDA margin of 16.2%, higher by 400 basis points as compared to previous year. This was driven by strong profitable performance in our B2C business of branded textile and branded apparel and supported by other businesses as well. As far as operating cost is concerned, our operating cost stood at 478 crore during the quarter, which was higher by 43% as compared to previous year level of 334 crore, primarily due to increase in revenue. However, with such continued strong focus on optimizing operating expenses, we have been able to lower the OPEX by 18%, that reflects upon a savings of 102 crore over pre-COVID third quarter fiscal 20 levels, 580 crores, while revenues were at similar levels. Additionally, from an interest cost perspective, based on the deleveraging and interest rate optimization, we were further able to reduce interest cost to 57 crores in third quarter fiscal 22, which is lower by 11 crore as compared to 68 crore in third quarter fiscal 21 and lower by 21 crore as compared to 78 crore in third quarter fiscal 20 pre-COVID levels. The average interest rate level for the quarter was at 7.96%. On the working capital front, we continued our focus on efficient working capital management, and overall our working capital decreased by 161 crore to 1101 crore as on 31st of December 2021 compared to 1263 crore as on 30th September 2021, mainly through reduction in receivables driven by strong collections throughout the quarter. On number of net working capital days, it also reduced by 19 days from 73 net working capital days in September 21 to 54 net working capital days in December 21 based on quarterly annualized revenue basis. From a cash flow perspective, driven by strong operating performance, we reported strong operating cash flows of 379 crore and free cash flow of 320 crore for the third quarter of fiscal 22. On a debt, the gross debt stood at 2,125 crore as on 31st December 2021 as compared to 2,206 crore as on 30th September 2021. At the same time, the cash and cash equivalents was higher by 229 crore and stood at 872 crore as on 31st December 2021 as compared to 643 crore on 30th September 2021. We were able to reduce the net debt by 310 crore and the net debt stood at 1,253 crore as on 31st of December 2021 as compared to 1,564 crore as on 30th September 2021. Here I would like to reiterate the fact that over recent times the company has embarked on a deleveraging plan and has undertaken multiple steps in that direction with the purpose of enhancing shareholder value. In December 2019, we infused 350 crores as a preferential issue from net proceeds from sale of land by an associate company and utilized the entire amount for reducing debt. Additionally, during FY21 and in the current year, which a period impacted by multiple waves of pandemic, our strong focus on cost optimization and effective working capital management, our deleveraging strategy has been well. The key achievements have been, we were able to reduce the net debt by over 600 crore, that is by 443 crore during FY21, from 1859 crore in March 20 to 1416 crore in March 21, and by 163 crore in current year from 1416 crore in March 21 to 1253 crore in December 21. This improved debt structure through effective refinancing with 3 to 10 years maturities of long-term debt continuously improved the net debt to equity ratio from a 0.75x in March 20 to 0.65 in March 21 to 0.58x in December 21. Now, allow me to take you through our business segment-wise performance. Branded textile segment reported strong growth of 49% to 899 crore versus 603 crore. In the suitings business, there was strong volume growth across all categories of wool, blends, polyviscose and gifting solutions. We offered collections catering to new trends and fashion. Our offerings in wool-rich blend has received strong response from our customers, and also there has been high demand for the premium gifting solutions catering to the wedding season. In the shirting business, there has been a strong volume growth in the cotton shirting category. We received good response to our Whites collection, a latest collection of vibrant shirting fabrics addressing the needs of casualization that are available across cotton and linen blends. From a channel perspective, primary sales was mainly driven by a renewed optimism among trade channel partners post unlocking that drove good revival in wholesale and MBO trade channels on the back of improved buoyancy for festival demand, strong wedding-related demand. Even we talk about the secondary sales, which continued to reflect higher momentum in Q3, and in our TRS network, we witnessed the ATV increase of 13% compared to pre-COVID levels due to improved consumer sentiment and increased footfalls. The segment reported healthy EBITDA margin of 21.2%, higher than 433 basis points compared to previous year, mainly driven due to increase in sales and realization. The growth was also driven by better product mix, as there were higher sales of polywool blends and benefit from 2 to 4% price hike taken for across categories in bookings done in mid of the year and overall operating efficiency. Now let me talk about the branded apparel segment, which recorded a sales growth by 50% to 316 crore vis-a-vis 211 crore during the third quarter of previous year, and the EBITDA margin improved to 10.7% as compared to 3% in previous year. The growth was driven with strong recovery in consumer demand with the opening up of markets as restrictions were removed and footfalls increased in the retail outlets in the festive and wedding season. Over the last few quarters, our successful initiatives such as cost optimization, focus on consolidation of back-end processes and serviceability, store rationalization, channel-specific merchandise, and online penetration helped. These initiatives have worked very, very well for us and helped us in becoming leaner, making us operationally more efficient. We continue to focus on enabling growth through widening the product portfolio, increase in online presence, network expansion through franchise model, and continue to constantly work on back-end consolidation for improving efficiency. We have received overwhelming response from our customers for our new collections in our core product portfolio, casual category, and category extension in ethnic category. Our store network and LFS doors witnessed higher footfalls and observed higher traction. Keeping up with the demand of fresh collections with quick turnaround of merchandise, we have witnessed growth in trade channels. We have also received very good response from our curated special lines for e-commerce marketplaces. Aggressive marketing campaigns in digital as well as other media in targeted cities during festivals helped to strengthen our brand and also drove the footfalls across all our stores. The segment reported a healthy EBITDA margin of 10.7%, mainly due to better sales along with higher realizations, improved gross margin, better channel mix, and continued operational efficiencies. Regarding our retail network, the network as on 31st of December 2021, we had 1,411 stores spread across 600 towns. With opening up of markets and revival in consumer sentiment, we witnessed strong traction in secondary sales with improved average transaction values. In the Raymond shop, TRS network recorded 13% growth in average transaction value as compared to pre-COVID levels. We are strongly focused on making our EBO portfolio healthy. During the quarter, we closed 21 underperforming stores, and currently we are in the last phase of store rationalization process, while at the same time we are continuously evaluating opportunities to strengthen our retail footprint. During the quarter, we opened 12 stores across tier 1 to 4 towns. Let me talk about the garmenting segment, where the sales grew by 48% to 203 crore compared to 137 crore in previous year, driven by continued strong momentum in export market. Growth in bulk business was driven by high demand from customers from US, UK, Europe markets. And with the China Plus One adoption by some global brands and elevation to critical supplier status has helped us in driving customer acquisition. EBITDA margin for the quarter improved to 8.6% due to better utilization levels and operational efficiencies. When we talk about our high-value cotton shirting segment, where the sales grew by 1.7 times to 148 crores compared to 86 crores in previous year due to higher cotton fabric sales in domestic markets as strong demand from B2B customers at the backdrop, lower inventory levels maintained at the and higher secondary sales during the festival and wedding season. The segment reported EBITDA margin of 8.6% for the quarter, impacted mainly due to higher raw material prices and lower contribution from higher margin yarn business. During the quarter, the engineering business was consolidated under JK Files and Engineering Limited, which is a 100% subsidiary of Raymond Limited. On an aggregate basis, the sales grew by 28% to 209 crores as compared to 163 crores in previous year. Sales growth mainly driven in export markets out of US, Europe, Asia and Africa, and in domestic markets there was continued improvement in demand across categories of products which we supplied. The business reported lower EBITDA margin of 15% mainly due to increase in raw material prices and freight costs, which was partly offset by higher productivity and efficiency. Real estate segment grew by 177% to 175 crore from 63 crore in previous year. While there has been a strong demand in the overall real estate sector, with key drivers being affordability driven demand, rising income levels and low mortgage rates. Our real estate business witnessed strong growth due to higher number of bookings and fast-paced construction activity in all 10 towers of the 10X Habitat project, as the revenue is recognized on percentage completion method. Overall, Project 10X received 208 bookings in third quarter fiscal 22, resulting in total of 1,763 units booked, which is 73% of the total inventory launched till 31st December 2021, with a booking value of 1,722 crores. During the quarter, we launched the premium residential project, The Address by GS, and received an overwhelming response with 117 bookings in third quarter fiscal 22 itself, with a booking value of 252 crores. Now let me update the tower-wise construction status. Tower 1, 2, 3, 4 is above terrace work in progress. Tower 5, 6, 7, 15 slab work in progress. Tower 8, 6 slab work in progress. Tower 9 and 10 plinth work completed. The excavation work is in progress for the premium residential project, The Address by the GS. Let me also give you an update on the consolidation of the businesses undertaken, which was announced on 27th of September 2021. As far as the consolidation of engineering business is concerned, during the quarter, we have done the consolidation of the engineering business. Post-consolidation, Ring Plus Aqua Limited is a subsidiary of JK Files and Engineering Limited. This consolidation is expected to help in bringing in synergies in terms of product applications, business development, sourcing of raw material, logistic services, and overall administrative process. In line with the stated strategy to monetize the business, thereby deleveraging Raymond Limited, JK Files and Engineering Limited has filed DRHP with the regulatory body for raising 800 crore through offer for sale of shares held by Raymond Limited. Currently, we are awaiting the regulatory approval. The next was consolidation of B2C businesses, including apparel, into Raymond Limited. We have received the shareholders and lenders approval for the same, and currently the scheme has been filed with NCLT and awaiting the approval thereof. In terms of subsidiarization of real estate business, the board approved the real estate business division to be subsidiarized into wholly owned subsidiary of Raymond Limited. Now, let me talk through about the current status of operations and the near-term outlook. We are seeing strong consumer demand led to revenue recovery to the pre-COVID levels and with the current momentum, we expect to improve the operating performance and to be on a profitable growth path. In the domestic market, from the last week of December, there have been rising concerns over the third wave of the COVID pandemic. While there have been state-level restrictions, ban on large gatherings, however, it has been more of relaxed restrictions and limited lockdowns, including weekend lockdowns and night curfews. Overall, consumer sentiments are positive with double vaccination and expected to be progressively improving with waning of third wave, while trade channel is cautiously optimistic. In the garmenting segment, the export demand levers continue to be strong, and China Plus One strategy adopted by our customers and better sell-through due to consolidation of global brands at retail level. Also in the US, UK and Europe regions, despite spike in cases, the demand is expected to continue as there was no major lockdown imposed by any country. From a raw material perspective, the wool prices and polyviscose have been stable, and we expect it to remain the same for short-term basis. As we all are aware, the cotton prices have increased by nearly 100% over the last 1 year, and given the commodity prices continue to remain high, we expect that the cotton prices will remain higher during the year. In the engineering business, we expect good domestic retail demand in our main consuming sector and higher export demand driven by industrial segments. The expectation is on the steel prices to soften. However, freight costs continue to remain an area for monitoring as there is a shortage of containers which results in delay in the shipments as well. As far as real estate outlook is concerned, we expect the growth momentum in the residential market to continue. From Raymond perspective, the construction activity in our real estate business is in full swing in both the projects, and we are on time to deliver the first 3 towers of 10x Habitat ahead of the RERA timeline by almost 24 months. From an OPEX cost perspective, we are on track to exceed the stated guidance of cost savings of 300 crore in fiscal 22 as compared to fiscal 20. As far as an industry outlook is concerned, we are expecting the union budget to be announced shortly, and we are hopeful that there will be further impetus for improving consumerism and expect reforms that increases the spending power of the consumer, which will provide opportunity for Indian economy to achieve a higher GDP growth in the coming years. We also expect government to provide an impetus on infrastructure development and capitalize on the China Plus One adoption of global companies, which would boost the employment and income levels that triggers domestic demand. Government incentives and support to fuel the growth in textile and apparel sector, presenting Indian players with huge export opportunities. Government to also incentivize Make in India and indigenous production of textile and related products. Factors which would support the growth of textile and apparel include increased penetration of organized retail, favorable demographics, and rising income levels triggering drive demand for textile and apparel. Increased aspirations in tier 3, 4, 5 towns has helped to improve the spend on the branded clothing. Rise of omni-channel convergence and mobile-led e-commerce. Today, Raymond, with its very strong brand name and nationwide presence in 600 towns and cities, is the market leader in suiting and shirting fabric company. With continued innovations through our strong R&D capabilities, supported by vertically integrated manufacturing facilities and focused omni-channel developmental capabilities, we are emerging stronger than ever before to capture the growth potential in the market. On the engineering business, our focus on consolidating market leadership, particularly in the industrial files and automotive segment, increase wallet share with our existing customers, increase presence in non-auto exports, and continue to build relationship with our white label customers. We are expanding the existing manufacturing capacity across our product categories of cutting tools, ring gears, water pump bearing, and flex plates. In the real estate business, in line with the company's growth plan to expand its realty horizons beyond Thane, the 10X Realty Limited, the step-down wholly owned subsidiary of the company, has recently signed a binding term sheet for joint redevelopment of a residential project in the western suburban district of Mumbai. The project is estimated to have an aggregate revenue potential of around 2,000 crores over a period of next 5 years. We will provide further updates on the same as soon as there is any meaningful progress. Along with strong potential for growth, we would continue to focus on liquidity management through cost reduction initiatives and net working capital optimization. We aim to be a net debt-free company over the next 3 years. Thank you very much, and now we are open for questions.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Thank you. The first question is from the line of Harsh from Motilal Oswal. Please go ahead.
Yeah, hi. Am I audible?
Yes, you are absolutely audible.
Yeah, hi. Thank you for the opportunity. I just wanted to ask, what is our outlook on the lifestyle business?
Okay. So, as we talked about... Sorry? We couldn't hear the last bit. You asked the question about outlook on the lifestyle business.
Yes.
Yeah, okay. So look, as we mentioned, that we have seen a very robust demand, so to speak. The recovery compared to the pre-COVID levels has been witnessed very clearly in the third quarter, and that is backed by the strong festive and the wedding season. Now, if I look at the current quarter as well as going forward, there's still a large number of weddings which is expected to happen. And based on the strength of the weddings and people coming back out of the COVID, there's a strong vaccination drive. We see a strong demand coming on our way. And you all know that if a wedding has to happen in our country, there has to be a Raymond fabric or an apparel to be worn at any point of time. And on the other hand, we have also a leg in terms of export, which is the export of fabrics and the garments to the matured markets, be the US, Europe, and UK. We have seen very, very strong demand. We are full to the tune of till June 2022. As we speak today, we have been seeing almost for the last 7-8 months ahead, 6-month order book has been full. And we are looking at very clearly some of the new customers, large retailer out of Europe, whom we have been longing to do the business. They have come and engaged into a detailed discussion in terms of style, collection, pattern, and this is clearly happening on the back of China Plus One strategy. So we are obviously benefiting out of that as well. And our facilities both in India and Ethiopia are running around the 80 to 85% of capacity utilization as we speak today. So we feel very, very confident about this.
Thank you. So that was really helpful. Just a small follow-up on that. Are we seeing any slowdown in our demand, which is led by this new variant coming in, or any impact of the Omicron? Are we witnessing any slowness in that demand, or what is the ground like in the last couple of months or in January?
Look, you see, what happens is, and I think a little bit on the lighter side, this Omicron variant, has not been so severe. If you see, people have been getting well between 5 to 7 days. So, and the restriction or the lockdowns has not been at all on a countrywide. There has been some lockdowns here and there, but in the late hours. So that has not really impacted the shopping hours. Maybe one or the other place, Delhi or some Uttarakhand, had seen some of the lockdowns during the weekends and such things. However, by and large, we have not seen such a restriction. Maybe there is a little small in the first 2 weeks, But after that, and the first 2 weeks, till 14th of January, in any case, things are a little weaker considering the period. And now, good strong wedding season is ahead of us. So all our dealers are demanding the products. And I can go out to say that people are asking in such a manner that they ordered last week and they expect a delivery in this week or next week. So people are expecting a lot of fabric to be delivered to them.
Thank you. Thank you. That was all from my end.
Thank you.
Thank you.
The next question is from the line of Meet Jain from LKP Securities. Please go ahead.
Hello. Hi, sir. Congratulations on the good set of numbers. My question is regarding the textile business. Like, we have achieved a very good revenues in this quarter, and the margins are also on the higher side. So, with the current trend you are seeing, like the upcoming wedding season is still there. So, you are expecting going forward also we can maintain this kind of run rate in both our revenue and margins?
In terms of the revenue, textile being a little bit of a seasonality plays into the way. So you have always a third quarter, a very, very strong quarter with the festivals as well as a strong wedding season. But also then you have the polywool blend, which is far more in that quarter vis-a-vis in the next quarters when the summer starts to come in, the polywool starts to come lower as a percentage of the overall. So to that extent, on a seasonality adjusted basis, we see the robust revenue to come in higher than previous years, as well as in terms of improving the margin, because what we explained to you that as a business from fiscal 20 level, which is truly the pre-COVID time, we have been able to reduce our fixed cost, our OPEX cost by 400 crores. And I think that is something which we have been able to work very judiciously, that where to spend money, where not to spend money, and how to spend. So therefore, that is something which is going to help us in consistently improving our EBITDA margins.
Okay, so like we did around 21% EBITDA margin this quarter for textile business, and our historic average has been in the range of 15 to 17%. So are we going to maintain that kind of range going forward, or it will be a little higher than that?
So it will be higher than the margins which has been historically maintained, because the OPEX cost reduction is going to help us to improve the margins.
Okay, thank you. And the next question is, like, in this quarter we have a higher effective tax rate of around 45%. So any particular reason for the same?
Yeah, so look, in terms of the higher tax, I'll give you a simple explanation. During the quarter, what we have been able to do is we took dividends from our two subsidiaries of almost 100 crores. And when you consolidate the results, the dividend income gets netted off, eliminated. However, the tax incidence on that remains the same. So therefore, if I take out 100 crore of dividend income on which you end up 30%, if you knock off that 30%, then we have a standard tax rate of around 28%. So that's the reason.
Got it. And the last question is on this new tower real estate projects of Premium. We say that we have booked around 50 plus units in this tower in this up till December 21. How many units have we launched currently?
So basically what we said to you that within the launch and 31st of December, that is practically 45 days, we have sold close to 116 units. And the total number of units is 180 launched, and of that 116 we have sold.
Okay, out of 180, 116 have been sold. And okay, got it. So, thank you for the opportunity.
Thank you.
Thank you. Reminder to all the participants, to ask a question, you may please press star and 1. The next question is from the line of Harsha from Dimensional Securities. Please go ahead.
Yeah, hi, good afternoon, sir. So we have seen...
Harsha from Dimensional Securities, your line is unmuted. Please go ahead with your question.
Audible now?
Yeah, please speak a little louder.
Yes, if you could speak a little louder.
Yeah, sure. So, sir, we have seen significant raw material inflation in last few quarters. So, if I look at your branded apparel and textile division, can you give us a breakup in terms of volume growth and price growth for this quarter?
So what happens is, if I talk about in terms of the inflation, we have been easily able to pass on the raw material inflation on the branded textiles. be it the cotton, be it on the wool prices, we have been able to do that. In terms of the volume, there has been a small improvement in terms of the volume, because you see, we have to be very careful that you don't want to overflood the market, but you want to be clear that the demand for your products is there, and based on the demand you supply the product which is of a different quality. Now, what we have been also able to do, as I talked in my opening remark, that we have improved the mix. So if you improve the mix on a poly wool blend, you get maybe lesser meterage, but your margins get higher. So that is the whole trick that is being played on a day-to-day basis, and our effort, which is the number one player as a worsted player in the country, your effort is to bring customers more and more to the wool segment, worsted segment, which is much more profitable vis-a-vis the polyviscoses of the world.
So when we look at the sales growth of around 49-50% in your branded textile and apparel business, you mean to say that volume growth there would be negligible? Most of it would be price hike or revenue mix?
No. So in terms of compared to 50%, you have almost 22 to 23% is the volume growth, because in the last year the volume was significantly, 28 to 29% is the volume growth, and the balance 8 to 9% is on account of mix, and the balance 10% is on account of a typical price increase. That is the way you should break it up.
Yeah, okay, yeah, that is what I was looking for. And sir, in your high value cotton business, which is a B2B business, why is it that we were not able to pass through the raw material inflation? Because in B2B, most of it is passed through, right?
Yeah, so I'll tell you, in B2, you asked about B2B, right?
Yes, high value cotton business.
Yeah.
Hey, this is Ganesh here. The high value cotton business primarily gets into the B2C channel, which is the branded channel, and only a small portion gets into the B2B. And there we have been, in the B2C channel, we have been able to recover most of the price increases that we have incurred. And in the B2B also, since high value cotton is a very small percentage, the price increases have been passed on to the buyers.
And just to add, what is happening is, there are two things. One is on account of typical raw material, which is the cotton or the linen flax. That price increase you have been able to pass on. However, there has been certain price increases on the dyes and chemicals. You all know the chemical industry has gone through a very different phase during the last third quarter, where the prices have jumped up, even the coal prices. So in the quarter itself, such inflation has not been able to recover, but now effective 1st of January, we have been able to increase the prices on our cotton fabrics for the B2B, because B2B players are typically the ones who contract the price for a little longer period than on a spot basis. So those price increases we are going to benefit in the 1st of January onwards.
Yeah, because there is stark contrast between your textile and apparel business, where the margins have improved considerably. But in case of high value cotton, your margins have nearly halved from 15.1% to 8.8%.
Yeah, you're right, because the reason being, one, clearly in your branded fabrics, you are getting a significant premium for a brand, which is always the case. And once you have the resumption of the demand, you are selling at a decent level, your pre-COVID levels, your cost, fixed cost dilution and everything starts to play out. Whereas on the B2B segment, what happens is, you are delivering to the customers who are eventually going to be the apparel makers, where, as I mentioned, the prices are not moving every day, which you change the prices at a certain periodic level, and there is also a lag. In a B2B businesses all across, you will always have a lag, and after that lag you start collecting, and once you correct it, then it remains with you. So therefore you will see that the price change of any inflationary pass on a retail is far sooner compared to in a B2B business where there is a lag.
Okay, and similarly for our engineering business, even here we have seen some correction in the margins. Of course, raw material inflation would have played its part. So here, do we expect the margins to return back to normalcy after a lag of few quarters?
Yeah, absolutely. So what has happened is, if you see the overall margin we have delivered is 15%, and 15% if you see over the last few years, that has been consistently growing up. It used to be 12%, then it went to 13, then it went for 14.5. And over what has happened is, when you look at the third quarter of last year, why the margin was so high? Because we were sitting with a very high inventory of steel, which was at a lower price. And during the last 3 quarters, the steel prices have moved up. And there has been, obviously, there is certain supplies to a B2B segment where you get a delay, there is a lag. And therefore, we will collect it, but it will be with some amount of lag depending upon the country, export. And let us also not forget, in engineering sector, we export 50% of our goods are exported, and the freight rate increases has been to the tune of 400%. Now, freight rate increases, it takes a while to recover it back. So that's the reason.
Okay. So here the sustainable margins would be in the range of for engineering division as a whole.
So look, on engineering business, as we talked about, and that we have these margins. You have seen the performance in the first quarter, you have seen the performance in the second quarter. The average of the same, you can consistently consider that could be the margin.
Okay. And lastly, on the real estate side, have we booked any revenue in our premium project, the address?
No. So if you look at it, the way the business, as you do the accounting, you do on a percentage of completion method. And since in the last quarter, the project was launched and there was hardly any work done, so we have started the excavation now. And based on that excavation, from this quarter onwards, we will start booking the revenue.
Okay. And so out of 252 crore which we have booked, how much have we received? How much has been collected?
No, so basically, when you do these kind of things, at the time of booking, anything between 2% to 5%, depending upon various customer base and various arrangements, you collect that amount. But for me, the most important is somebody who has already come in, made a booking, and that reflects upon the confidence of the project that out of 180 odd apartments, 116 bookings have been made.
So just to add to that, as per RERA, the legal requirement is that I cannot collect anything more than 9.99% till I have registered the agreement. And from sale to registration of agreement, it is any time between 2 to 2.5 months timeline is needed. So in any case, by law, I cannot collect more than that till the registration happens. So most of this 10% or 15% money will get collected towards the end of Q4, by March.
Okay. And just one last question, that is on the liquidity side. So we have nearly 650 to 700 crore worth of cash on our books, and we are running some debt as well. Now, with the COVID hopefully almost coming to an end, what is the plan here? I mean, do we expect to continue to maintain same level of liquidity on our balance sheet, or we would retire some debt and bring down the cash level?
So look, very clearly we have demonstrated that we have been able to consistently reduce the debt. And the focus now is to become a net debt-free company over the next course of time. Now, as far as this cash is concerned, look, this cash is available and we have been able to draw lesser and lesser our cash credit working capital lines. Second thing, if you look at it in terms of your thought about the negative carry, the way we have been able to borrow now on a recent past in the last 2 to 2.5 months, we are able to borrow at a phenomenally cheaper rate. So the negative carry is very, very small. And considering the COVID impact, we have been seeing every 6 months or so the COVID wave comes in. So it is much important that you have the dry powder available with you so that you can draw upon these facilities, draw upon this cash balance at any point of time. So let's go through a journey when we see 6 to 9 months of clean period where you are not impacted by pandemic, and then we can take it forward.
Sure. Understood. Thank you. Thanks a lot.
Thank you. The next question is from the line of Prerna Jhunjhunwala from B&K Securities. Please go ahead.
Hello. Thank you for the opportunity and congratulations on strong set of numbers. Just wanted to understand your cost reduction strategy. So in one of your slides, you've mentioned that there has been a substantial 9-month the substantial reduction in the cost in the 9 months over the last 1 year. Now in this year also we had the first quarter when we were hit with COVID and stores were closed and stuff. So there would be some operating expenses which would have got reduced over there as well. So how should we see your cost structure going forward, and what should be the sustainable cost reduction in absolute terms, even when we reach pre-COVID level of operations?
Yeah, no, absolutely. Wonderful point, Prerna. I think if you look at it, we have been showing that if I consider even the most recent quarter, third quarter fiscal 22, we have been able to reduce our cost by 100 crores compared to the third quarter of fiscal 20, which was a comparable pre-COVID quarter. And overall for the 9 months, we have been able to reduce 400 crores. And we gave the guidance that for the whole year, our reduction compared to fiscal 20 was 300 crores. So we are ahead of that. And this is clearly demonstrated that it is not just because of the COVID period. However, it is going beyond the COVID period. So what has happened is certain structural changes which has been brought in terms of manpower, rental savings, the way you do the advertisement, the way you go about sales promotion activities, the way we used to hold this big trade shows which would cost 30-40 crore. So like we explained to you last time also, that every single item has been looked, and we have started to work on a zero-based budgeting so that we do not increase the cost. Now, as far as this year is concerned, we are very clearly seeing compared to the fiscal 2020, 400 crore has been already achieved, and obviously some more savings will come in the Q4. So in well ahead that we have been able to reduce the cost. If I look at it, you see in the first quarter, which was maybe pandemic-led, 30% compared to that, Q2 27%, Q3 around 20%. So very, very clearly, we are seeing that we will be able to maintain a decent cost reduction on a go-forward basis. However, at some point of time, you have to also consider the impact of the inflation. If I would consider fiscal 20 and adjust it by the inflation, even with a 4.5%, you can imagine that we are sitting in the savings in this quarter itself by more than 175 crores of savings, because that is normally one would go out and give that inflationary increase. So that something needs to be also incorporated.
Okay. And so could you guide us on your new businesses strategy of growth, like ethnics, khadi, and FMCG businesses, which have been quite small today but can see substantial growth going forward? So what is the strategy there, and what kind of growth can we expect in these businesses?
Okay, let me start with the ethnics. I think that's what we are focusing on as the growth lever. And we have reworked our ethnic strategy, and what 3 aspects that we are going to look at. First is the Raymond shop is a natural destination for wedding purchases. So that is where we are going to expand our presence, and we are going to make sure that all those Raymond shops where we have space to offer or where we can expand, we are going to offer ethnics as a range to the shopping. Second is on the EBO network. From the current network, we are planning to double the network expansion over the next 12 months. And if things go on well, we will probably get into a 3x mode as well. I think that's the second area. Third, of course, which is a very fundamental to this business, is what are the offerings that we give to the consumers. So we have set up a process of understanding the consumer insights on the trends and the fashion that we are offering on the ethnic side. And that is where we are going to expand in terms of the core ethnics as well as the casual ethnics range. And that's where we will build capabilities for us. I think broadly, the assumption is that Raymond shops are the is a logical wedding destination, And that's a leverage which we would capture and build the ethnics business. For FMCG, I will give it to Amit.
Sure. So look, FMCG is a very strong business. You know, FMCG, as we speak today, we are currently in our category, which is the DO category, which is down as we speak today. Considering the markets, people have to go out, then people use more DOs, and as people are not going out, but slowly and steadily, this is a very strong category which could recover. We enjoy a healthy market share of 17 to 18%, and we see a huge growth opportunity for us. As we talked earlier, we see this revenue over the next 4 years to double from the level where we stand today, and also improvement in the margins. So very, very clearly, a very, very robust business for us, which has a significant potential and capitalize on the strength of the marquee brand, which is the Park Avenue and the KS.
Okay. So a follow-up on this ethnic strategy. Just wanted to understand, you are planning to open separate ethnic stores, or it will be a part of the TRS, because when you talk about Raymond as a destination for wedding shopping, it will include all your blazers plus shirts, pants, and as well as the wedding day attire or things like that.
So to answer to your question, there is an opportunity for us to leverage on the existing Raymond shop, which is one of the strategies that we will do. It is not an either or, because there are certain markets, certain catchment areas where you need to have exclusive brand outlets as well. So it will be a combination of both Raymond shop as well as EBOs. And plus we will of course tie up with LFS. We will also tie up with MBOs, select MBOs, where we'll offer this range. So we will have formats of EBOs under 3 categories, which is mostly in terms of the size of the market, business opportunity in terms of 1,000 square feet, 1,500 and 2,000 square feet. I think that's what we are looking at.
Okay. And the last question is on profitability. This quarter we've seen substantial improvement in profitability, especially in the branded textile and branded apparel businesses, which we've been waiting to see, 20% plus in branded textile and 10% plus in the branded apparel kind of business. Now, how sustainable these margins are? I'm sorry if I've joined late, if these questions have been answered earlier also. Just wanted to get clarity on this.
Sure, Prerna. Obviously, you see, I'll tell you, as far as the branded apparel is concerned, we have spoken number of times that in the last 18 to because of the pandemic, people have not been able to go out to the shopping mall and the streets to do the shopping in a normal desired manner. And the shopping of an apparel is not just dependent that you are a destined shopper, you go and buy this. If you go for a meal, if you go for a movie, you see something nice and you pick it up there, and that is called in impulse shopping, where people are not really looking for the last discount and everything. Second, if I look at it, as the demand is so strong and the products, the new lines which we have introduced are so strong that the discounting on the EOSS have come down substantially. Second thing, if I look at it in terms of an intake margin, very, very clearly we are seeing an improvement in the intake margin. Third, all said and done, we have rationalized the cost in this segment of our business in a very, very large manner. Be it sampling cost, be it the distribution, be it the rental you need to pay. So we are very, very mindful that if the X number of X volume of sales happens, then you can pay Y only rental, even if it is in the most attractive location. So all those careful evaluation is being done in order to see a healthier growth in revenue. And we know very well, if I look at 316 crore is a decent revenue which brings a decent profitability. So therefore we expect that this profitability will be continuing and give us a robust revenue going forward.
Okay, and in branded textiles, can we expect a little more margin because wool prices are going down?
No, so branded textile, as explained also, that in branded textile what happens is, it's a very seasonal business. So you will find in wool segment, which is sold typically in the winter time, your margins are way higher. And in the polyviscose and others, the margins are slightly lower. So seasonally adjusted, if you consider, we can easily see, as the trend has been in the past, with a couple of improvement in basis points in terms of the EBITDA margins going forward.
Okay, sir. Thank you, sir. That answers all my questions. All the best. Great set of numbers.
Thank you.
Thank you. The next question is from the line of Kunal Shah from Jefferies. Please go ahead.
Yeah. Hello, team. So I have just a couple of questions. I'm not sure if they are answered earlier. So first is with the third wave coming in January and some restrictions in certain states, have we seen any change in our revenue momentum from the December quarter?
Actually not, because what happens is typically you see, we all know till 14th of January the sales is little lower because of the time, and post 14th of January the sales starts to improve considering the wedding starts to come into the way, and the wedding plays a very, very important role in the revenue. So, and maybe it is little bit coincided also with the Omicron variant, especially in the tier 1 cities. And however, the sales get impacted when you have a countrywide lockdown or a statewide lockdown or during the shopping hours lockdown, while in this Omicron variant, you have not seen any of these things happening. Maybe in far and few there you had some weekend lockdown or late night hours, which is not typically a shopping hour. So the activities were practically happening. There was a small here and there dip, but can I say it was a remarkable, significant drop? Answer is no. So we don't expect any major concern as we speak today, but it is very difficult to predict which kind of variant and when it erupts. So,
yeah, in fact, this is one thing which we have to live with. I think as business houses, as retailers, what we have also started looking at is how do we prepare for this. So one is the revenue from the stores itself. Second is also how do we reach out to the consumers and how do we service their requirements. From both this combined together, I think we are in good stead and we can tackle any sort of challenges that come in. 3 points that one needs to remember. The lockdowns are typically localized, and lockdowns are not full day lockdowns. It is basically restrictive time hours. So whereby whatever shopping needs to be done is still happening. That's point number one. Second, vaccination is increasing with every passing day. I think that's the other point which is also ensuring that people come to the stores, the malls, etc. And we have seen this evolution over the last 18 months from the first pandemic onwards, that now people are no longer scared of not going out into and doing shopping if required. And the third, which is very, very critical, is the weddings, the celebrations, the events have started going back to the original scale in terms of people wanting to get their relatives, their family, their friends celebrate. So that is becoming much, much more prominent, and thereby the impact on the retail for us, at least from what we are seeing in our Raymond shops and the EBOs, is not so significant.
Got it. That's very clear. The second question is, so the recovery that you've seen in the last 6 months, and especially this quarter in the festive season, do you see any divergent trends between, let's say, metros and tier 1 towns and, let's say, smaller towns, since Raymond has a fairly broad, EBO network or TRS network?
Yeah, in fact, the tier 1 basically had a slow start, but today across zones, we have recovered the sales, and all of them are doing fine. The only point which all of us need to remember is tier 4, 5, 6, which during the pandemic also did not go down because it was always there. The second trend which we are also seeing is an improvement of ATV, average ticket values. So that has gone up by about 10 to 13% in a range. It has gone up, and that is still continuing to be going strong for us.
And let us understand very simple that the 25 lakh weddings which people talked about and our dealer distribution network talked about between November, December, it can't be between 1 or 2 towns, tier 1 and tier 2 towns. It is spread all across the country, and considering that it is spread, celebrations are spread all across the country, it benefits us.
Got it. Thank you. That's all from my side.
Thank you. The next question is from the line of Siddharth Mohta from Principal India. Please go ahead.
Yes, sir. Good afternoon to you, sir. Sir, historically, sir, we have seen strong top-line growth in branded apparel and textiles, but it used to be at an expense of working capital. But this time we have witnessed strong sales growth without compromising on working capital, as reflected in our strong cash flow and debt reduction. So what were the few changes that we have done in working capital policy, in the sense tracking secondary sales more closely, system-driven, and hope company to maintain the same discipline in working capital without sacrificing on the growth, sir?
Absolutely. I think this is, pandemic has taught us a lot of things. What we did was very, very clear that we took certain discipline that we will go out and sell to our dealer network, franchisee network, on the premise that we will give you all sorts of facilities, all provisions, all collections and everything. But there is one simple condition, that when the amount is due, you will pay that money. And if there is a certain delay which is not acceptable beyond the normal framework, we will stop the deliveries. And now that kind of a discipline which we took has clearly helped us to improve our performance in terms of receivable management. Second thing, what we have been also very careful was that whatever is typically required when the store needs, and that is why which I mentioned in my earlier script, that we were getting orders last week to deliver in 10 days. So that also a faster turnaround time from our plants, so that people get the right quality of inventory which they can sell sooner, helps them to move the whole cycle faster. Third thing, in terms of our plant locations, we cater the plants in such a manner in demand planning in a way that they will produce specifically to the requirements of the customer and without compromising on cost, obviously, but very specific. So when we do a booking, we know exactly what is to be done, and we were very, very careful in terms of our demand planning and delivery. If people do not take their inventory, it is very clearly told that there would be certain penalties which will be imposed upon these guys in order to take the business, and the next time they will come stand in the queue at a later point. So therefore, there is a lot of discipline, and I think the entire company has very clearly focused that working capital is a key and it cannot be compromised for the sake of achieving sales. And that is why, as I told you, that we are sitting as one of the lowest working capital in terms of number of days in this company over a long period of time. And we have not compromised sales. I can tell you, we have hardly compromised any sales because it is a discipline.
Absolutely.
Hygiene.
No, sir. So that is very heartening to know. And sir, hope that the same discipline and the same alignment between working capital and the sales will continue going forward also. Sir, my second question, sir, is on this Ethiopia unit. Sir, any update on that? How is capacity utilization going on? Is that unit has become profitable?
Absolutely. So look, that business is doing around 80% of capacity utilization, and you know the attractiveness of Ethiopia having the what you call free trade agreement. So the supplies made out of Ethiopia to the US and all do not have to end up paying a duty, export duty. So that has really made an 80%. We were very clear. If these facilities go above 70%, it is a cash machine. So therefore, we see good volume and good profitability coming out of Ethiopia.
Yes.
You want to add?
Yes. Secondly, we have also added new customers into Ethiopia to whom we are supplying. So that also added to the capacity utilization. And we are also looking at how do we diversify the product range as well over there.
Okay. So that is up and running.
Yes.
Yes.
Sir, regarding this, yes, sorry, sir.
Today it is such in our export markets, I can keep on adding more capacities and the orders keep coming to us. So it's such a good market as we speak today.
Okay, sir. Sir, so any plan to expand the capacity as that unit is running at 100%, or any plan to do some deep bottlenecking there?
So look, we consistently do that. It is not that we don't do that. We consistently do that. And I'll give you a classical example in our engineering business. We plan to double our capacity over the next 3 to 4 years. And we have seen an increase in our capacity at the engineering plants because basically you get the orders. The whole philosophy of the group is that you secure orders or order pipeline and then you invest then in capex, not to invest before and then look to chase for an order. So we develop the market, we develop the line, and then go and create the capex.
Okay, sir. So you have mentioned that within 3 years, company plan is to become net debt free. So, but seeing the very strong cash flow and assuming the IPO that we have planned to do for the engineering segment and it comes, and 700-800 crore it flows into the company. So the combination of IPO plus strong cash flow, do you think that is being a bit conservative guidance that you have given?
I think sometimes it's better to be conservative, no? But you're right. You did the right math.
Correct. Sir, and final question, sir, is on the tax front. So can you please help what it will be, because this time taxation part it is on a bit higher side.
Yeah, but maybe you were not there when we
I missed
explained. Yeah, so we explained that during the quarter we took 100 crore of dividend from our subsidiary companies, and when you consolidate the results, the 100 crore dividend is nullified or eliminated. However, the tax incidence on that is around the 30 crores, and if you knock off the 30 crores, then your tax rate comes down to 28%. So which is a normal tax rate. We believe that is a normal standard tax rate we will continue to have on a go-forward basis.
And sir, my final question, sir, we do a bit of exports. Are we eligible for any export incentive from the government side?
So we do quite a bit exports. I'll ask.
Yeah. So across fabrics, garmenting, and the engineering business, there is a export, and whatever is the export incentive available at that point in time, that is eligible, and we get. In fact, there are some which has been withdrawn. The NEIS, etc., has been withdrawn, but there are others which are still there, and we get export incentives. We are eligible, and we are also getting the cash flow clean into our system.
Great, sir, and best wishes for upcoming quarters. Excellent results.
Thank you.
Thank you.
Thank you.
Thank you. Ladies and gentlemen, this was the last question for today. I now hand the conference over to Mr. Abhijit Kundu for his closing comments. Over to you, sir.
Yeah, thanks. Thanks for participating in Raymond's conference. Thanks for all the questions, and we thank the management of Raymond Limited to give us the opportunity to host the call. Over to Mukund.
Thanks everyone. In case of any other further queries, please reach out to me.
And yeah, thank you very much. Look forward to talking to you in the next quarter.
Thank you, ladies and gentlemen. On behalf of Antique Stock Broking Limited, that concludes this conference call. Thank you for joining us, and you may now disconnect your lines.